Hello everyone. In continuation of the previous lecture of double entry system, I'm just giving the example in this current presentation. For this, I'll repeat the previous slides as the double entry system. I have explained in my previous slide about the double entry system. What is double entry system? Double entry system is what where the debit where every transaction has two aspects, debit and the credit aspects. And these are the rules on the basis of these rules, we can record the transaction, we can debit the transaction, we can credit the transactions. And these rules are developed by an Italian merchant. I'll let you know about a small story of the development of these rules. These rules are developed by Italian merchant, and when he was struggling with the recording, when he was facing the record problem in recording, he was recording in every transaction in a different manner. And so at the end of the year, he was not able to compare, he was not able to take out the profit, he was not able to take out how much profit he had earned from this business. So he just developed these rules, and these rules are followed by everyone, followed worldwide same, and there's no changes in the rules. Everyone is following the same rules and regulations, and these rules are also known as the golden rules of accounting. And I'll start with the example how we can record the transaction in the books. Process of recording the transactions with the example. The first example is started business with cash rupees 3,000. So here the two accounts involved, first is cash and second is owner's equity or the proprietor who has invested in the business. So the cash is an asset of the organization, and so it will be debited because the company is receiving the cash. So as per the real account, it should be debited. And who is the giver here? The owner or the proprietor. So it will be the credited for the company. So the transaction will be cash account debit to the capital account. And bought goods, second transaction, January 2nd, bought goods worth rupees 2,000. The two accounts affected by this transaction are cash and second is goods. And cash balances is decreases, so it will be credited. And goods, what comes in the organization, that should be credited. So the purchases account will be debited here. In case of purchase of the goods, we write the purchase on the place of the goods, and when we sell the goods, we write the sales on the place of the goods. Remember this thing always. And the second transaction will be purchases account debit to the cash. Third transaction on January 9th, received order for half of the goods from G. Remember this thing. And there is no transaction, there is no give and take activity, there is no monetary transaction, so we cannot record in the books because the order is placed only. And the order is placed, it doesn't mean that there is any transaction. For the transaction purpose, I have already told you, for the transaction purpose, the transaction means there should be give and take activity and there should be monetary involvement. So there is no transaction because the order is only received. So the order can, on the basis of the order only, if the goods are transferred or if the payments has been received, so we can write in play, otherwise we cannot write in the books. The next example, analysis table for the following transactions. Mr. Ram started business with cash rupees 20,000. So for this, you can say the two aspects. First is the cash, and the second is Ram. Here the cash comes and the Ram is the giver. So the cash account will be cash account, and the first account is the cash account, and the Ram is the giver. So we will write the capital account on the place of the investor or the proprietor. Types of the accounts, cash comes in the real account and the capital is credited as per the personal account. So what comes in as per the real account, what comes in debited, and who is the giver? The capital will be the giver. Ram is the giver, so we will write the capital. So the transaction will be cash account debit to the capital. Second transaction, goods purchased for cash rupees 14,000. So here you can see goods comes in and cash goes out. Two accounts, purchase account and the cash account affected by this transaction. Both comes in the real account because the assets and properties comes in the real account as per the real account rule. What comes in debit, what goes out credit. So the purchases means goods is coming in the organization and cash is going out. So the entry will be purchases account debit to the cash account. The third transaction is salaries paid rupees 5,000. Here salary is an expense. Salary, the two accounts are salary and second is cash. Salary account will be debited as per the nominal account and the cash account comes in the real account. So as per that cash will be credited. And the transaction will be salary account debit to the cash as per the salary account as per the nominal account salary is an expense, so it will be debited and cash comes in the real account and it is going out from the organization, that's why it is credited. So the transaction will be salary account debit to the cash. The next transaction is sold goods for cash rupees 5,000. Here two accounts are cash and sales account. Both comes in the again real account. What comes in cash is coming when you are say when the company is selling the goods and goods is going out from the organization. So the transaction will be cash account debit to the sales account. Here the goods on the place of the goods we have returned the sales because as I told you that at the time of the purchase of the goods we will write the purchase, at the time of the sale of the goods we will write the sales. Now the next transaction is furniture purchased in cash rupees 5,600. Here furniture again is furniture account and the cash account because when the company is purchasing the furniture, cash has to be paid for that. Both comes in the real account. So furniture is the asset. What comes in, that's why it is debited and cash is credited because the cash is going out. And all the assets and properties, again I'm repeating it, all the assets and properties comes in the real account. So we will see the real account. Remember this thing here, you can see it is not necessary the rules are different from in debit and the credit. Both the accounts means in last two examples you have seen the real account rule is applicable only, so for the debit and the credit. And the last is withdraw cash for the personal use. Who is using that amount? The owner who is withdrawing the amount from the organization. The first account will be drawings on the place of the owners or the proprietor when he is withdrawing, when he is taking out something for his personal use from the business. We will just write on place of the proprietor the drawing account, and what is taking out from the organization, cash. So the cash will be the credit. The transaction will be transaction will be drawings account debit to the cash. Here the drawings is debit because the receiver is the owner, and on the place of the receiver's name we will write the drawings. We cannot write the name of the owner in its own book, in its own is business book, and the cash is going out, that's why it is credited. So in these examples we can see what the transactions we have done till now. So thank you so much. In the next video, I'll explain you some more examples of the journal entry. So for the better understanding, thank you so much.